Desde APLA creemos que generar espacios de debate es generar transformación. Te invitamos a nuestro primer encuentro virtual de sostenibilidad. Nos estamos preparando para nuestra próxima reunión, trabajando en una nueva plataforma para hacer tu experiencia más amigable e intuitiva. Ya podés agendar este encuentro. Te esperamos.
Bueno, buenos días de nuevo, segunda versión. Lamentablemente a veces tenemos estos pequeños detalles, pero la idea es poder seguir agradeciendo totalmente a nuestros asistentes, a todos nuestros moderadores, a quienes son nuestros speakers, los socios, sponsors, y queremos simplemente invitarlos a las próximas reuniones que vamos a estar haciendo, la primera de sostenibilidad el 28 de septiembre y luego la tradicional anual del 8 al 9 de noviembre. En esta reunión es la primera vez que vamos a estar haciendo la interpretación por señas, nos va a estar ayudando Jimena y Gabriel, así que ustedes van a tener la oportunidad de poder ver también esto a través de señas. Esto fue una gran iniciativa de uno de nuestros socios y amigos, que es Mesucan, un operador logístico integral muy importante y que nos ha dado la oportunidad a nosotros de poder también ser cada vez más inclusivos. Así que sin más preámbulo y básicamente tratando de que todos ustedes puedan disfrutar de esta nueva plataforma que tenemos de networking, llamada All in One, donde van a poder hacer todo aquí, es importante marcar siempre la visibilidad de cada uno cuando se registra, de modo tal de que puedan hacer reuniones face to face bajo el entorno Zoom. Bueno, más nada tengo para decirles, solamente pasarle la palabra a Juan Carlos Ferretti, que va a ser el moderador del próximo panel. Muchas gracias.
Manuel. We will now talk about chemical tankers, a very complex tanker segment serving many industries and extremely important for the supply chains of petrochemical industry. We have today the pleasure of having Josh Saxby, who works for Clarksons Platou for almost a decade. He's the global head of specialized product and analysis and consultancy, as well as divisional director of the specialized product business. Leading a team of 6 people in London and Singapore, the specialized product analysis team is deeply embedded with the brokers, adding value to every stage of transaction process. Josh and his team work and an array of different clients, including charter ship owner, investment bank, and private equity funds, leveraging their unique data and insight strategies. In addition, Josh is also heavily involved with Clarksons PLC technology subsidiary, Maritech Group, and its strategy and marketing for the sea and suite of products. So we welcome Josh very warmly. It's a pleasure having you here, and we will enjoy your presentation. So please, Josh, go ahead.
Thank you, JC. Good morning, everybody, from a rather sunny London after the last few weeks where it's just rained incessantly. So I'm very happy to be here today. Thank you for the invitation. I will, as JC said, I'll be going through a short snapshot of the chemical tanker market, looking at the key supply demand fundamentals, the driving tonnage demand within that sector. And I'll also do a couple of slides towards the end on environmental regulation, alternative fuels and carbon emissions, because of course that is something that touches all of us involved in the shipping sectors, no matter whether you're in chemicals or containers or gas. It is something that we all have to be very much very focused on right now. So I'm going to just share my screen. So just bear with me 1 second. I'm hoping everybody can see that. Sorry, 1 sec. Okay, here we go. So as I said, we'll start from the top. We're going to be looking at the chemical tanker market from very high above, and then sort of getting into the exactly what's going on. So let's start with the first slide, looking at demand fundamentals. Of course, the chemical tanker market is very much driven by macro megatrends, such as social mobility, urbanization, and world population growth. And of course, I think most people are just very interested as to what's happened in our sector during the COVID-19 crisis or pandemic. And what this slide serves is just to show you where things have been historically and where we think things are going to go. Now we are hopefully coming to some sort of conclusion of this pandemic. So on the left-hand side, you have historical seaborne trade for specialized products. Now, specialized products, just to cut through some of the terminology here, refers to anything that is organic chemical or an inorganic chemical. It also includes veg oils and palm oils, molasses, lube oils, ethanol, bitumen, and biofuels. So that's what specialized products covers. And so you'll see on the left-hand side chart here that there's been consistent year-on-year growth in seaborne trade up until 2020, when of course the pandemic hit. But what we can see from the previous years, and the last 40 years, is a very strong correlation between world GDP and specialized products trade. And that is something that is not that surprising if we think about the macro mega trends that I mentioned at the very beginning that drive the sector. So we see a 0.9 correlation. So in other words, we're saying that world specialized products trade grows at the same rate as world GDP, so around 3 to 4% per year. And on the right-hand side, you can see this, that from 2007 to 2019, there was an average growth rate of around 4%. But COVID happened, or is happening, and it severely caused us to question whether the GDP growth scenario was the correct one to follow. And the reason for that is at the very beginning of the pandemic, I'm sure many of you will recall that the IMF released some pretty large estimates in terms of decreases in world GDP. So in March, April last year, when they were released, we saw around 5% year-on-year decrease in world GDP. But as the pandemic took a hold across the world, and as the year carried on, it was very clear to us in Clarksons that we were doing more volume than we expected. There was more volume being fixed and more volume being moved around the world than was expected. And so it called us into question, is that should we really be looking at GDP by itself, or should we be looking at other data sets and variables that can give us a clearer picture as to what is actually going on? Ultimately, what happened last year is that seaborne trade only contracted by 1.6% year on year. So that is a lot less than the 5% that we thought may happen at the beginning of the year. And what we did is we took a multiplier of both GDP and industrial production to give us an idea of where we believe seaborne trade will go over the next few years. And what we have here, therefore, is that 1.6% reduction year on year. And in 2021, we expect around 3.8%. increase year on year. So in other words, 2021 volumes are going to be just above 2019 volumes based on where we are today. Now, of course, and I'll come on to this in more detail later on, this is very much dependent on the continued success of vaccine rollouts, both the developed and underdeveloped world. So should there be any hiccups or any unforeseen new COVID variants that vaccines are not effective against, we may actually find that seaborne trade doesn't grow at the rate we feel it will do today. Lastly, what this does show us, and which is something that we should be quite positive about, is the resilience of the chemical tanker sector. The myriad of products that we are involved with, the thousands and thousands of different products that have their own demand and supply drivers, means that the demand destruction that was seen in tankers, crude oil, products, and dry cargo was not repeated in the specialized products market. So that's what's really key, and that is why we saw a much better performance in seaborne trade last year than we expected at the beginning. Looking at this in a little bit more detail, why did we choose industrial production? Well, firstly, it's available on a monthly basis. We don't have to wait twice a year for the IMF to release GDP. We can factor that into our own data, and it really gave us a more up-to-date idea of where things were going in the key economies of the world. Prior to the COVID pandemic, you can see that both Atlantic and Pacific IP were expanding year on year. It was only in 2019 that we started to see Atlantic IP start contracting, and that was mostly driven by the US-China trade war and the previous Trump administration. But overall, it wasn't a huge impact. But you can see in January, February of last year that the Pacific IP dropped off a cliff. The moment China and the other producing regions and importing regions of Asia were hit and they shut down, everything stopped. But you can see that following the recovery of the first wave, there's an uptick in industrial production, and then it takes a while for it to settle down. But actually, from the second half of last year into this year and beyond, we are seeing month-on-month increases in industrial production. And what that means, therefore, is that even in second and third waves, the markets have been able to function and supply chains have been able to function without any massive impact on tonnage demand within our sector. You see the same in Atlantic. The first wave in Europe, the US, and South America, when they hit in April, everything stopped. But the same trend you see from the second half of last year into this year, an increase month on month in IP. So this is why we use IP as a secondary variable in our forecasts. And I think that gives you a clear idea as to why we believe that the resilience of the sector is so important to the longevity and the overall performance within over the last 18 months. We also look at PMI. We don't factor this into the overall forecasts, but it's just another tertiary variable we can use to keep a track on where things are going. So let's look at China first and foremost. Again, like IP, you see the drop-offs for both services and manufacturing in the first wave. But immediately following that, you start to see these sectors expand once more. And yes, there is a little bit of up and down in services in China, but that's obviously going to be down to lockdowns. But overall, it's been expanding since that first wave. The US, exactly the same, albeit we see services and manufacturing PMI increasing month on month, regardless of what's going on there. And the reason for that is basically the federal makeup of the US means that, as we all know, every state is pursuing its own COVID-19 policies, more or less. So that means that chemical manufacturing areas of the US Gulf, Louisiana and Texas primarily, have been able to continue manufacturing, and their supply chains have continued to remain open despite the disruption seen elsewhere. But let's look at Europe. Again, you see a big dips at the beginning of the first waves. And again, you see services PMI falling off again during the second wave at the end of last year. Again, like the US, the Eurozone is made up of lots of different countries, as everybody knows, following their own policies. There's no one single policy. But again, manufacturing has increased month on month despite COVID. So that underlying demand and that resilience from the sector remains the driver for tonnage demand. Services PMI has only just started to recover in the last few months. And the reason for that is purely the fact that the services sectors, hotels, restaurants, bars and everything are reopening now in Europe, more or less, because of the success of the vaccine rollout. So I mentioned at the beginning that we also had a less severe than expected contraction in seaborne trade growth last year, 1.6% decrease. We also saw the actual volumes that Clarksons were fixing a lot higher than we expected. What was driving this? Well, whilst I'm not going to dwell long on containers, but we all know what the containers market is booming at the moment. But what I want to show you here is that you've got the seasonality of the Chinese New Year every sort of January, February time. And then of course here you have not just the Chinese New Year, but also you have COVID. But following that, you see a big uptick in containerizable exports from China. And this shows the demand for finished plastic goods. Basically, the feedstocks that are needed, the bulk chemicals that are needed to make these finished plastic goods are absolutely key to the performance of the containerizable export market. We call this the Amazon or Alibaba effect. Everyone was at home, everyone was ordering more stuff. They were setting up their home offices. No one had anything else to do, so they were spending money on finished plastic goods. And what you see is that at the end of last year, that containerizable exports from China peaked at 27 million tons. And then you had the Chinese New Year, as usual, in February this year, before a very quick recovery once again. This is really, really key for us to understand that demand and manufacturing supply chains within the Chinese markets remains strong. And once again, throughout 2021, we continue to see strong volumes being moved into China on a monthly basis to fuel this manufacturing activity. So bringing the demand side of the presentation to a close, let me just recap. We've got increasing seaborne trade despite COVID, 1 year with not. But what does that mean for tonnage demand? Well, this is really quite interesting. So I want to show you on this slide the average haul of the fleet and what that means. So this map shows the global movements of the specialized products fleet or chemical tanker fleet over 1 year. The darker the colors, the more intense the trade. So of course, intra-Europe is very intense and also intra-Asia is very intense. Let's put COVID to one side for now and cast our minds back to 2015. Prior to 2015 and the earliest part of the 2010s, there was a big growth in intra-Asia trade. So you had smaller voyages taking place over shorter spaces of time and shorter distances. And as a result, we started to see the average haul of the fleet decrease by about 1 to 1.5 percentage points per year. However, from 2015 onwards, the US liquid chemical shale gas projects started to come online. And these were all for bulk chemicals. So you had larger vessels tied up for longer periods of time, mostly servicing the Asia markets. Now, whilst that market is still very much in the development phase, you still had the Middle East Gulf to Far East trade supplying the Asia market. The Middle East China trade, Far East trade, accounts for 7% of all specialized products trade. China alone counts for 25% of all organic and inorganic chemical imports. So these two trade lanes together started to push the average haul of the fleet up. And you can see on the right-hand side here that there is that upwards trend. There is an anomaly in 2017 where there was too much supply in the market, not enough demand. And you can see since then that average haul has increased. Even in 2020, average haul of the fleet increased. So that shows us, again, the resilience of this sector in the face of the pandemic. And we expect further increases into 21 and 22, as you can see on our projections here. So that's absolutely key for future deadweight demand. The continued development of the US liquid chemical projects based on shale gas is very much down to the forward projections of the average haul of the fleet. The continued investment in the Middle East for bulk chemical production is also absolutely key for this average haul of the fleet. On top of that, which is not shown here, is also the increase in biofuels trade from China into Europe. So again, that is also helping to push the average haul of the fleet up, and that is something that will continue to increase as well. So we have increasing seaborne trade despite COVID and increasing average haul. What does this mean for the fleet? Because of course, when we understand the fleet, we start to get an understanding of what might happen for freight. And of course, freight is the most important thing here when it comes to any chartering activity. So what we have here is the development of the chemical tanker fleet. We've got the historical deliveries, which are the dark blue bars. We have scheduled deliveries, which is what is on the order book today, the bright blue bars. We have actual scrappings or removals, and then we have a removal scenario. So this is for the two types of chemical tanker that are out there: coated tonnage, which has a 20-year removal scenario, and stainless steel tonnage, which is a 25-year removal scenario. I should explain that the chemical tanker fleet is comprised of any vessel that has an IMO class. What I want to draw your attention to is the net fleet growth, which is the yellow line. And you can see that we are going into a period of contraction over the next 18 months. It is extremely unlikely that we will see any big chemical tanker orders put down in the next 2.5 years, 2 to 2.5 years. The reasons for this are several. First and foremost, we have a booming container and dry bulk sector. We know that the shipping markets are cyclical, and we know that they're characterized by boom and bust. We are seeing a huge amount of container and dry bulk ships being ordered, and they are eating up yard space. At the same time, you have a very high steel price, and you also have a general lack of available finance. Before COVID, there was a lack of finance. During COVID, there was even less finance. And today, there is finance available, but it's only just starting to open up again. So unless you are an owner who has a very strong balance sheet and is able to extract the most out of the earnings potential of these types of vessels, that is the only point where you're going to be able to put new orders down. Chemical tankers have very stable earnings. For want of a better description, it's simply not a sexy investment. Private equity has withdrawn from the sector pretty much, and the number of shipping banks out there that are willing to get involved within the shipping sector full stop continues to contract. On top of this, we also have the alternative fuels and green transition going on. And this green transition is only going to get more and more important as the years go by, as you know. So what I want to basically reiterate here is that the contraction of the fleet that is due over the next few years is going to be a key driver for freight rates. The order book stands at below 6% of the in-service deadweight as I sit here talking to you today. That is the lowest it's been in 20 years. That is not going to change, unfortunately, if you're a charterer. If you're a ship owner, it paints a slightly different picture. Let's look at this in a little bit more detail on the regional and deep sea. You see that most of the investment has been in deep sea fleet over the last 10 years. So that's greater or equal to 17,000 deadweight. The regional fleets, intra-Europe, intra-Asia, you do not see the same levels of investment. And as a result, you see that that area of the fleet is in contraction already. The deep sea fleet will also contract, but not until 23. But this is where the majority of the investment interest that is still in the sector remains. And that really is the driver for how things will go forward in terms of any new orders that we may see, which, as I've said, will be limited. So, of course, now we know that the fleet is going to contract. We know that seaborne trade will increase, and the average haul of the fleet will increase. There's a fourth theme here that I need to introduce you all to, and this has a wild effect on chemical tanker freight rates. The influence of the products tanker market, and by products tanker, I'm referring to clean petroleum products. So that is naphtha, jet fuel, gas oil, gasoline, and dirty petroleum products, fuel oil, and the like, is massive. It has a big impact now on what happens to freight rates in our sector. Most of these vessels that in the products tanker sector have what we would call part IMO capability. So on paper, that means these ships can trade in our sector, mostly for edible oils, but increasingly we're seeing them try and get into bulk chemical volumes as well. Now, the owners of these vessels generally do not have the knowledge or the know-how or the operational expertise to trade within chemicals. But the importance of it and that trend means that the chemical freight is extremely closely linked now to what happens in the products tanker sector. And you can see this here no more clearly than what happened in the contango floating storage play of April 2020 to May 2020 last year. You may recall crude oil prices dropped off a cliff, the contango came into the market, and we saw a lot of floating storage being taken from the VLCCs, Suezmax, Aframax, LR1s, LR2s, all the way down to MRs, medium range petroleum products carriers. And you can see that the product tanker earnings, the average MR earnings index, hit historical highs. It's unlikely to be seen again, but it did hit $75,000 a day. And what happened to chemical spot freight rates, and this is a basket of chemical spot freight rates from around the world, you can see that they followed suit. We had these products tanker vessels leaving edible oils, leaving bulk chemicals, and therefore that led to reduced competition in the chemical spot markets and allowed freight rates to be raised. And they were raised for quite a long time. It was only towards the end of last year, as we'll see in the next slide, that freight rates actually came below the long run average. So I really need to stress the importance of this relationship, and the 0.7 correlation, as it shows, is very, very key to the overall performance and influence that this sector now has on the chemical markets. Let's just look at this in more detail. We have the historical highs and lows here from 2008 to 2020. Majority of these highs in Q1 and Q4, as you can see, were mostly in the two prior to the financial crisis in 2008. They haven't been hit again until last year, when what is normally a very quiet quarter, Q2, Q3 are the quietest quarters for chemicals, we see freight rates hit historical highs. And this was driven by this products contango floating storage play, less competition, owners were able to put freight rates up as a result of constricted supply, and also the number of vessels that are required to carry the same volume also increased. So that led to 6 months of pretty good freight rate environment. The long run average, which is the grey line that runs through the middle, you can see only in the Q3, Q4 of last year did freight rates actually hit long run average, and they actually finished the year below. And that is what we would have expected in a pandemic-driven market. The only thing that stopped these freight rates going lower than we thought they would was the strength in contractual volumes into Asia. 2021, Q1, was very, very tough. Spot demand was very, very weak, and there were still so many questions as to what would happen with COVID. Vaccination rollouts had only just begun. Nobody quite knew if it would work. Coming to Q2, we see a combination of the OPEC plus group of nations agreeing to extend oil supply cuts. We see a raise in bunker prices, then obviously a rise in freight rates. We saw knock-on effects from the closure of Houston during the very bad weather they had in February, March. We also had small impact from the blockage of the Suez Canal. However, it's only today that we have now matched the long-run average. So this shows us where the market is today. We're still way below where we were this time last year. And spot freight rates will not recover to be run along the long-run average or even go above it until the products market recovers. The demand destruction that I spoke about at the very beginning, that the tanker sector experienced due to COVID, remains very much in place. So all the additional tonnage that's competing within the edible oils and chemical sector is keeping a lid on these freight rates for now. We don't expect the product sector to recover really until late 2021, possibly January 2022. So it's going to be quite challenging for a few months yet. Let's talk briefly about the environmental regulation. Of course, there's been an awful lot of discussion about this across the shipping markets in recent months. It's happening. Conventional fuel oil will no longer be the fuel of choice in the next 20 years, even less if you're EU, 10 years. And what we have in the chemical tanker market at the moment is 24 ships that are in service, that are LNG based, and you can see that LNG is the main fuel of choice at the moment, whilst methanol, and then you've got methanol as the other one. So 11 ships there, 14 on order, another 19 LNG on order. The issue is, however, is that, as I mentioned on the previous slide about the order book, if I just go back quickly, because of the concerns that we have here, in terms of getting finance, in terms of finding yard space, in terms of being able to put down a sizable order for alternative fueled ships, it means that we're not going to see much of a change in this makeup over the next 2 years. And as it says, there's limited application in the chemical tanker sector. You can see overall, the number of vessels is still very, very small. On a wider basis, we are looking also at things such as ammonia as a fuel. Personally, I don't think we're going to be seeing that scaled up in any great scale for at least the next 15 or so years. Reason being is that there's just simply not enough infrastructure or money around to invest in blue ammonia and green ammonia. There will not be a ship on the water that is able to burn ammonia as a bunker fuel in 2025. So we're still some way away from ammonia being a reality. The answer really here is that it's going to be a cocktail of different fuels rather than one single winner right now. LNG is the one that many are looking at. Methanol is gaining in prominence, but overall, it's still far too early to say what will be the single fuel to replace fuel oil. It's simply not, we're nowhere near that point yet, and we won't be for some time. Of course, this is all happening against the backdrop of regulation. I'm sure you're all familiar with the, okay, clear, I will wrap up. We're all clear on the European emissions trading system. That's coming in January 2023. That is going to increase owners' cost bases. So we can talk about this offline if anyone would like to ask any questions. But short answer is that owners are going to have to start paying on a carbon per ton basis for the amount of carbon they release whilst trading in intra-European and European waters. We also have voluntary schemes that are coming into place for carbon neutrality, which we know stopping being able to deliver cargoes carbon neutral. This is something that's gaining in prominence as well, and we have seen one notable example of it already with crude oil. and we expect to see more as things go on. And my final slide is just to wrap up. We've talked about the fact that 2020 was a very tough year for everybody. However, there was a 1.6% decrease in seaborne trade. It wasn't as bad as many people expected. That resilience was absolutely key to performance. We know that this year Q1 was slow. We know that Q2 was also slow. We're now sitting in midway through Q3, and we are starting to see some improvement. I think we can all agree that there is a bit of improvement going on here. Quite when we're going to get to a point where manufacturing supply chains will return to pre-pandemic norms is not clear. It does, however, it is contingent, however, on vaccine rollouts. There is success in the developed world at this, but the underdeveloped world is a long way behind the developed world. And that is key for import demand. Q4, I've talked about CPP and petroleum products, and overall, we don't expect the chemical tanker market to improve until such a time as the petroleum products market improves. And that is not until the end of this year, arguably into 2022. And that concludes my presentation.
Superb presentation, very clear. I hope we have time for one question at least. And I would like to ask you, how do you think the regulatory landscape will affect the net fleet growth and the new building activity? You partly answered that already.
What's going on this slide is going to be a key driver for the new building activity that we should see going forward. You'll see on the slide that the emissions, the ETS system will cover all intra-EU voyages, but it'll also cover 50% of the emissions from all international inbound and outbound voyages. It doesn't matter if you do not trade within Europe all the time, you are still going to have to pay for this. So the ability to be more efficient through alternative fuels will be the driver to mitigate increased costs. However, as we saw, the new build situation is not going to change. So ultimately, when that measure comes in January 2023, the majority of the fleet that is on the water today, across every shipping sector, not just chemicals, will be in a position where they're going to have to pay this tax and increase their costs. Yard space is tough. It's very tight. In 2008, there were 300 plus yards. Today, there's around 150. It's halved in 12 years. There is not enough yard space to meet this demand. $3 trillion worth of investment is required to renew the global shipping fleets. We're a long, long, long way from that being achieved in the short term. This is a 20, 30 year renewal that we're looking at here. Does that answer your question?
Yes. Thank you very much. Unfortunately, we are running out of time and we have a tight schedule. So just to thank you very much for your time and your work. It has been a super presentation. We enjoy a lot. And thank you for having the time to share with us.
Thank you, JC. And thank you to everybody on the call and listening today. You'll be able to get my contact details from the team at APLA. So if anyone would like a copy of this or to discuss things in more detail, please do let me know.
Thank you.
Thank you very much.